In April 2021, the underlying infrastructure of cryptocurrency arrived on Wall Street. When Coinbase went public, its blue logo glowing across Times Square signaled to the broader market that digital assets had matured from a fringe experiment into an established financial sector. Millions of retail investors watched the surging prices and felt the fear of missing out. People began pouring their savings into this new ecosystem, treating highly volatile digital tokens with the same confidence they might give a traditional retirement account. To participate, these new investors needed a way to convert their fiat currency into blockchain assets. Centralized crypto exchanges provided that bridge, offering clean, user-friendly mobile apps that made buying Bitcoin or Ethereum as simple as ordering a physical product online. This massive wave of retail cash poured into an ecosystem that lacked historical regulatory safeguards. It created an environment flush with liquidity, leaving inexperienced investors vulnerable to traditional financial schemes dressed up as complex technology. At the center of this liquidity boom was Sam Bankman-Fried, the CEO of an exchange called FTX. With his unkempt hair and standard gray t-shirt, he presented himself as a casual, brilliant outsider, distinct from the typical Wall Street executive. He aggressively scaled the company's public profile, spending hundreds of millions of dollars to secure stadium naming rights and high-profile Super Bowl commercials. By acquiring endorsements from elite figures like Tom Brady, FTX manufactured an aura of institutional stability and mainstream approval. Bankman-Fried also actively promoted his adherence to effective altruism, a philosophy dictating that individuals should maximize their wealth solely to fund charitable causes. This philanthropic positioning functioned as a shield, deflecting regulatory scrutiny and charming prominent venture capitalists who viewed him as a morally driven innovator. Because of this carefully curated billion-dollar public image, the market viewed FTX as the most secure platform in the digital asset space. That reputation successfully obscured the reality of how the exchange actually operated behind closed doors. The foundation of the operation relied on a proprietary digital token called FTT, which FTX generated out of thin air to serve as its internal currency. Looking at this diagram of the token supply pool, we can see how the manipulation worked. FTX kept the vast majority of the FTT tokens locked off-market in a massive reserve. They allowed only a tiny fraction to actively trade, which made it incredibly easy to bid up the price and artificially inflate the total valuation of the entire supply. Once that reserve was locked in place at an artificially high price, Bankman-Fried used the illiquid FTT tokens as collateral. By treating these self-generated tokens as if they were equivalent to physical cash, he was able to borrow billions of dollars in actual hard currency from his own retail customers. The balance sheet of his corporate empire appeared robust, but its immense purchasing power was ultimately backed by a self-issued, heavily manipulated digital coupon that held no intrinsic value. That borrowed capital flowed directly to Alameda Research, a private crypto hedge fund owned by Bankman-Fried and run by his inner circle, including CEO Caroline Ellison. Alameda had engaged in highly leveraged speculative trades across the cryptocurrency market. When those positions failed, the hedge fund suffered catastrophic losses and faced immediate insolvency unless it could secure an external bailout. As this diagram illustrates, the executives had hard-coded a $65 billion line of credit directly into FTX's trading architecture. This hidden pipeline automatically siphoned retail customer deposits from the exchange side, moving them directly to Alameda to cover the hedge fund's massive trading deficits. Millions of retail customers logged into FTX assuming their digital wallets were secure vaults. In reality, fiat deposits were being drained daily to finance a rogue trading desk's continuous losses. The operation remained intact until November 2022, when an industry publication leaked Alameda's private balance sheet. The document revealed that the hedge fund's multi-billion-dollar foundation consisted almost entirely of those illiquid, self-printed FTT tokens, rather than actual cash. Recognizing the vulnerability, the CEO of a competing exchange publicly announced his intent to liquidate his firm's large position in FTT. The resulting price drop instantly destroyed Alameda's collateral value and triggered a market-wide panic. What followed was a modern digital bank run. Millions of FTX users simultaneously rushed to withdraw their deposits. Because Alameda had already spent the retail cash, the exchange lacked the reserves to honor the withdrawals, forcing a total collapse of the platform's infrastructure. Within a matter of days, a corporate valuation of $32 billion evaporated completely. The exchange collapsed under the weight of its own liabilities, exposing an entire enterprise built entirely on the blind trust of its users. Following the bankruptcy filing, the court appointed John Ray, the same restructuring expert who managed the Enron liquidation, to oversee the aftermath. He reported an almost total absence of reliable financial information and basic corporate controls within FTX. The federal investigation moved swiftly, with several top executives choosing to cooperate with prosecutors and detail the internal mechanics of the fraud. Bankman-Fried was found guilty on 7 criminal charges and sentenced to 25 years in federal prison. The failure of several crypto-focused institutions triggered a wider liquidity crunch across banks that serviced the tech and digital asset sectors. That panic eventually spread to regional lenders like Silicon Valley Bank, where a sudden, massive withdrawal of deposits forced yet another historic bank failure. The cryptocurrency industry was originally designed with the explicit goal of bypassing centralized Wall Street intermediaries. Yet, as the ecosystem grew, it recreated the exact same opaque, centralized financial structures it sought to replace, only this time without any of the traditional regulatory oversight. FTX serves as a case study in human fraud rather than mechanical failure. The catastrophe proved that even an industry built on decentralization is vulnerable to the same historic failures of centralized power and the danger of placing blind faith in charismatic middlemen.